In this video, I'm going to talk about the 18-year real estate cycle and why that is the most important thing for you to understand as a real estate investor. Why is that? Well, because once you grasp the real estate cycle, you'll learn the following. 1. That property prices tend to rise over the long term, which should give you more confidence that they will continue to do so. 2. You won't expect prices to rise in a smooth and steady manner. There will be wobbles and also inevitable crashes along the way due to how the financial system we live in is structured. And 3. Instead of relying on what the newspapers or media say about real estate prices, you can gain a better understanding of what's likely to happen next by paying attention to certain signs in the world around you. In a nutshell, many aspects of real estate investment that may seem random or uncertain will suddenly make more sense. Armed with this knowledge, you can, at the very least, avoid making the wrong moves at the wrong times that could harm your portfolio and your wealth. And at most, you can make the knowledge of the real estate cycle a central part of your investment strategy. However, you won't be convinced enough to take action based on it until you fully understand the reasoning behind it yourself. So let's dive into how you can make better investment decisions using the 18-year real estate cycle. But before we do that, we need to understand the underlying economics that drive it. So let's get started. Why is there a real estate cycle? In most markets, like goods such as cars or services like personal training, prices are balanced by the forces of supply and demand. For example, if everyone suddenly wants to get a personal trainer, the high demand will lead to higher prices. This attracts more personal trainers to enter the market, increasing supply and eventually bringing prices back down. However, the land market works differently because the supply of land is fixed. We can't magically create more land when demand increases. Even if planning restrictions are relaxed, demand is usually concentrated in established locations, making it difficult to increase the supply. The boom. As a result, when the economy grows and there is a demand for new homes, shops, and factories, the increased demand drives land prices up. Since there is no mechanism to bring prices back down, land prices rise faster than wages and prices of goods. This is known as Ricardo's law of rent and explains why rents have become a larger portion of the economy over time. People quickly realize this trend and understand that investing in real estate as a representation of land offers a great return on their money. So, during periods of high demand, people speculate by buying property, expecting prices to continue rising. The bust. Since real estate prices increase faster than wages, eventually property prices become unaffordable for most people. When this happens, the bust occurs. Real estate prices plummet, causing trouble for banks that have lent money based on high-priced properties. Banks reduce lendings, construction slows down, and businesses suffer. This has obvious ripple effects on stock market and employment levels. Eventually, prices reach a more sustainable level and things gradually return to normal. Then the cycle starts all over again. Importantly, each cycle starts from a higher low point than the previous one, so the long-term trend is upward despite the volatility along the way. That, in a nutshell, is the real estate cycle. It would be more accurate to call it the land cycle, since the cost of building a house on a piece of land is similar in different locations and remains relatively stable over time. However, house prices are more accessible for us to observe, allowing us to gauge what's happening in the land market and predict the future states of the wider economy based on real estate prices. But what are the stages of the 18-year real estate cycle? Economist Fred Harrison was one of the first to discover the real estate cycle, which he found to average about 18 years in length, broken down as follows: 7 years of initial expansion/recovery from the previous crash, 7 years of a secondary expansion with a final acceleration after a mid-cycle wobble/slowdown leading to a peak, and finally 4 years of falling prices after the cyclical peak. So 7 plus 7 plus 4 equals 18. So overall, 14 years up and 4 years down. Please note that those are average periods, so don't take those numbers as gospel, but just as a rough indication to guide your investment decision, as I'll explain later. Historically, the actual cycle has never been shorter than 17 years and never longer than 21 years. The actual exact duration doesn't matter, because once you understand the drivers of each cycle phase, you'll know at any point in time where we are in the cycle, what to expect next, and how to act accordingly. Now, you need to understand that the real estate cycle is ultimately very much aligned with the economic cycle. Also, you should take as a main reference the United States and be aware that the other Western economies generally lag about 1 year behind. The great thing is, once you understand the real estate cycle, you can forecast it, because history does repeat itself, not in exactly the same way, but in a similar way. But that is enough to take advantage of it, because if you can understand where we are in the cycle, you can forecast what's likely to come next. Hence, you can make money, protect your capital, make informed business and investment decisions, and build, grow, and protect great wealth. Okay, now to the actual cycle. Each cycle consists of different stages that we'll now explore. Now, you might have memories of experiencing at least one complete real estate cycle, maybe even more. As we discussed the indicators for each stage, you might recall the hints that were present in past cycles. This is important because if you don't seek your own evidence, the media can mislead you. Remember back in 2006, did you see headlines like "sell everything in the next year or two"? Or did you see headlines like "get the best 110% mortgage rates"? Look, the professionals who understand the cycle and monitor the signals act differently from the amateurs who rely on the media. And surprise, surprise, professionals make a lot of money while amateurs generally don't and often get burned. Now, let's examine each stage of the cycle, what triggers the shift to the next stage, and what different types of investors are doing and thinking at each point. Stage number 1. First expansion/recovery stage. We begin when prices hit bottom at the end of a recession and the recovery phase is starting. Prices have fallen enough to attract the boldest investors who seek high yields resulting from falling prices while rents remain steady. These investors, known as the smart money, are contrarian investors who recognize the opportunity to buy assets when confidence is low and the investment case is unproven. Amateur investors are usually absent from the market at this time, missing out on the favorable buying conditions. As the recovery phase progresses, more buyers gain confidence and enter the market, gradually pushing prices upward. Look for large companies and pension funds buying distressed portfolios, indicating a solidifying recovery. Growth typically starts in economically powerful city centers and expands outward. Stage number 2. Mid-cycle wobble/slowdown. After a few years of slow and steady growth and recovery from the crash, prices are now significantly higher than at the bottom of the cycle a few years before. We're at this point in the middle of the cycle where the early investors and those who got in around the bottom take some profit. That causes a market slowdown or a mild fall, which however will reveal to be temporary, despite what the media or public opinion might think. Stage number 3. Second expansion/acceleration stage. After the slight dip in the middle of the cycle as early investors profit, the recovery phase resumes and prices start gradually rising again. After a while, it becomes evident that prices are now increasing steadily and banks regain confidence and start lending again. This is the start of an acceleration in property price growth, which can become explosive as we approach the peak. Major construction projects commence, visible through the presence of cranes on the skyline. Property prices begin to rise significantly faster than wages, attracting media attention. People start speculating, upgrading their homes, or using increased mortgage loans for vacations and cars. Banks facilitate this by easing lending criteria. As prices continue to climb, group psychology takes over, driving further buying and pushing prices higher and higher. Smart investors quietly sell to secure profits while the mania persists. Stage number 4. Winner's curse. The final years of the explosive phase, labeled the winner's curse by Fred Harrison, sees prices and mania peak. However, this phase becomes a curse because the next recession is imminent and the property bought at the peak will soon decrease in value. Warning signs appear if you know where to look. Overblown building projects and justifications for perpetually high prices signal the nearing top. Stage number 5. Cyclical peak and crash. Eventually, reality sets in and the recession phase approaches. Confidence, driven by sentiment rather than fundamentals, can quickly vanish, taking the market down with it. Prices plummet, causing bankruptcies and forced selling, which further depresses prices. The exact timing of this downturn is uncertain, but the media will fuel panic with negative stories. The recession phase may seem prolonged, but it eventually ends. Smart investors become tempted to re-enter the market and the cycle begins anew. Now, how can we profit from the 18-year real estate cycle? So we've learned that the real estate market goes through different stages in a repeating pattern. This is important to know because it means that the prices going up and down is normal and not something to worry too much about. The media often portrays the housing market as either great or terrible, making it seem random, but is actually driven by basic economic principles and follows a predictable cycle. Knowing that the housing market moves through these stages allows us to anticipate what's coming next. Even if we can't predict the exact timing, just knowing that there's a pattern can make a big difference. For example, if we understand that prices won't keep falling forever and will eventually recover, we are less likely to panic and sell when prices are low. Some experts say that the cycle lasts around 18 years based on historical evidence, but it's not necessary to focus too much on the exact duration. The important thing is to recognize that there is a predictable cycle. Even if we don't know the exact number of years, we can assess where we are in the cycle and what's coming next by observing signals in the world around us. For instance, if we notice more construction activity and a slight decrease in prices after a period of slow and steady growth, it could indicate that we are in the recovery phase, with an explosive phase to follow. We've also seen that professional investors and amateur investors behave differently during the cycle. While casual investors often take on large mortgages to benefit from the market boom, those who are knowledgeable about the cycle quietly sell their investments and hold onto cash in preparation for the upcoming downturn. In other words, most people buy when prices are high and sell when prices are low, which is the opposite of what they should be doing. Commandments for profiting from the 18-year real estate cycle. I can't guarantee that understanding the real estate cycle will give you the exact knowledge and mental strength needed to buy at the lowest point and sell at the highest point in the market. But here's the thing, you don't have to. Remember, each cycle starts at the higher level than the previous one, so a buy and hold for 20 years strategy still works just fine. Plus, if you wait for years expecting prices to drop, you'll miss out on potential income. However, there are 4 simple commandments you should follow as an investor now that you know about the cycle. They should be easier for you to follow. 1. Don't panic and sell a property just because prices are falling. Due to the cycle, you know that prices won't reach zero, and it won't take too long, considering the bigger picture, for them to surpass their previous levels. 2. Avoid putting yourself in a situation where you're forced to sell at the wrong time in the cycle. This means not taking on excessive debt during the peak and ensuring that your real estate portfolio can endure temporary value declines. 3. Don't get carried away like everyone else does during the winner's curse phase. It's the worst time to buy because prices will soon drop and they won't recover to the level you purchased at until late in the next cycle. It's an even worse time to remortgage and use the cash for luxury item. You might think you wouldn't be that foolish, but many people were last time around. 4. Don't be misled by the media. As we've already seen, the messages they broadcast around the crucial turning points of the cycle are almost the opposite of what professional investors are doing. Ignoring all that noise is easier said than done, but it's essential for making the right decisions. By sticking to these basics, you'll already outperform most investors. However, if you want to take it a step further, knowing about the real estate cycle opens up some more advanced options, such as 1. Be a seller when everyone else is buying. The winner's curse phase is a terrible time to buy, but an excellent opportunity to sell. You don't have to sell everything, but it's the perfect moment to let go of properties that haven't performed as well as you expected and get someone to pay a premium price for them. Alternatively, you could sell everything. This idea may go against against the instinct of most individual investors, but it's what large institutional investors do. Set an exit price when you make the purchase, sell once you've achieved the anticipated gains, and then buy in a location that's at a different stage in the cycle, thus having greater growth potential. Speaking of which, 2. Be a buyer when everyone else is selling. It doesn't have to be exactly at rock bottom. People's memories of a market crash last longer than the actual economic reality. So even after prices stabilize and begin to rise again, real estate offices remain empty for some time. 3. Accumulate cash during the winner's course phase, so you're ready to swoop in when everyone else is selling. Mortgage lending becomes stricter when prices decline, so even if you are courageous enough to buy, you might struggle to access funds. Instead, you can prepare in advance by selling underperforming properties or refinancing your existing properties to more reasonable levels, thus raising funds. Wait a minute, didn't I just say 1 minute ago that refinancing during the winner's course phase was a terrible idea? Well, no, not if you're using the money you release to buy properties at a discounted price or to pay off the debt if you change your mind later. So I hope you're now convinced about the fascinating nature of the real estate cycle. You don't have to abandon the strategy of buy and hold and switch to market timing if you don't want to. Even if you simply stick to the fundamental principles, you'll still achieve good results. The key point to remember is that a market crash will happen without a doubt. At some point during your journey as a real estate investor, prices will decrease and it might happen swiftly. But if you know the cycle won't hurt you, like it does to most people, and you can even use it to your advantage to achieve even better results than you would have been able to otherwise. Now, if you want to profit from the real estate cycle in the best possible way by getting free access to some of the best real estate investment deals available and make some instant cash, in addition of course to building and growing wealth in the real estate market, well, then leave us your name and email address by clicking on the link below and we'll send you all the details. We'll also keep you in the loop on the next investment deals that we'll source for our investors, all free of charge. Because in case we didn't know, here at REMPIA we help people build a high-performing real estate portfolio or even a true empire hands off. How do we do it? Well, our connections and relationships with the best and finest players in the space allows our clients and investors to access the best and the most exclusive property deals that we source and negotiate on their behalf. So those investors who work with us save, hence make, tens or even hundreds of thousands of dollars even before completing on their purchase. Thanks to our network, on each of those deals that we present to our investors, you get to buy below market value in the areas we expect to have the highest capital growth, plus you get to earn a great rental income. We also support the investors who work with us at every stage of the buying process and after. Now, if you want to be able to buy below market value and or at a discount on each single real estate investment you make, hence if you want to be able to make pretty quickly tens or even hundreds of thousands of dollars on each transaction, plus of course if you want to build and grow wealth for the medium and long term very effectively, then get in touch with us. Register your interest by clicking on the link below and become part of our community of happy and informed investors. Now, how do we work here at REMPIA? Well, you'll be probably a bit surprised when I reveal to you that we don't show our investors a lot of deals and we don't put any pressure on them to invest in one. We only present our investors very carefully selected and vetted investment deals, those that we carefully researched and that passed our very rigorous screening process and due diligence. Also, the support and guidance we offer our investors goes far beyond just sourcing and passing on to them the very best possible deals on the best developments from the finest developers. We handhold our investors throughout the entire process, both before, during, and even after their purchase. Yes, because for those who don't sell their property before or immediately after completion and want to rent it out, we provide them with all the needed help, advice, guidance, and assistance so that they can truly maximize the rental income that their investment will produce in a completely hands-off way. So, if you either don't have the time, knowledge, insights, or network to source the best property deals, or if you're looking for a great income and/or for medium to long-term capital growth plus a quick capital appreciation thanks to buying below market value, or if you're looking to build and manage a portfolio in the most hands-off way, or any combination of the above, then you might want to get in touch with us because we surely can help you. So, what do we actually do here at REMPIA? Part of what we do is look for great quality properties in the best locations where the best capital growth is, with all the key fundamentals in place for best, medium and long-term returns at the best possible price, and in fact below market value. Also, we are very selective on the deals we source and offer our investors, which means we're very picky and only shortlist the best possible deals. And that's one of the reasons why when we launch a deal, the demand from our investors is always higher than the supply of available units, hence why we do sell out on each investment deal we launch. So, if you too want to have the chance to invest in one of our next investment deals that we'll be launching, just click the link below and you'll be the first to know about any great investment opportunities that we'll be offering. Right, all that being said, if you're finding this video interesting, valuable or inspirational, please don't forget to click the like button. Also, if you'd like to remain up to date with what we do and with how we can help you achieve your financial freedom goals here at the Financial Freedom Hub, or if you simply found this video valuable, in that case, if you haven't already, a subscribe would mean a lot to us because it supports the channel, and what that also does is give us an indication that we're building an audience and that we're creating helpful content for people. And when you do subscribe, remember to click the notification bell so that you can get notified as soon as we release a new video. Also, please leave a comment down below and let me know whether you're already investing in real estate and what your experience has been so far. And if you haven't invested yet, are you going to start thinking about it after watching this video? Well, I hope you do. In any case, share your thoughts with us and with the other Financial Freedom Hubbers in the comments below and let's get the conversation going. Also, let me know in the comments below what you would like our next video to be about. And finally, please share this video with family, friends, or with anyone you think could find this video or our channel interesting, valuable, educational, or inspirational. Right, that's it for now. Time for you to make a decision, I guess. If you want to start considering investing in real estate in the best possible way and start building and growing serious life-changing wealth, now you know what you need to do, right? Link in the description below. And once again, remember that action taking is a trait that characterizes all successful people and all successful real estate investors. You can become one of them starting today by grabbing this incredible opportunity and signing up to learn more about our free services. So I'm looking forward to connecting with you soon. And of course, I'll see you also on the next video. Until then, take action, ride opportunities, always seek true freedom, be resilient, be consistent, carry on persistent, stay relentless, and most of all, remain unstoppable. Oh, by the way, if you liked this video, I'm sure you're going to absolutely love the one or the ones appearing now on the screen. So I strongly recommend you go watch them right now. I'll see you there.